Okay, in this video I just wanted to sort of sum up why some countries will have a current account surplus while other countries may have a current account deficit. So some reasons for that would be, for example, that that country might export a high value of exports relative to imports. So they might be a country that exports a lot of oil. Most of those types of countries will have high current account surpluses. They might be a popular tourist destination, so a lot of people come there for holidays. Would also increase their level of credits or increase the amount of credits in the net services account. Countries that are owed a lot of money from other countries, so Germany and China, for example, that have lent a lot of money out to other countries would have a lot of money coming in terms of debits for interest. They might have a lot of foreign investment in other countries, so they've got a lot of profits flowing back to that country. In terms of reasons why a country has a large current account deficit, they import more than they export, they have a high level of net foreign debt, they've sold off a lot of assets, so there's a lot of profits flowing overseas. Then these are all reasons why Australia generally has a current account deficit. But large level of debt, lots of foreign investment in Australian companies, and the value of exports is generally lower than the value of imports. We also give some foreign aid as well. In terms of Australia's current account, why it's gone further into deficit in recent years, so the main reasons why our current account deficit is growing is that there's weaker growth in China. So the weaker growth in China has led to lower commodity prices, so we're receiving less credits for commodities, or the lower value of exports coming into our nation. That would be one reason. Another reason is the Australian dollar is still relatively high. So even though it's dropped down a little bit, the high Australian dollar hurts the tourism and education credits that we might receive. And the other reason is that because of the high levels of household debt, there's lots of interest still flowing out of the account because homeowners are going into more and more debt, and therefore they're having to pay more and more interest on their debt, and therefore that's leading to banks having to borrow money from overseas, and therefore more net foreign debt and more money flowing out of the current account, the net primary income section. So the big household debt levels are also hurting the CAD. I gave you this question in class, so I'm not going to look at this again. But basically this is a question that tests your understanding of how the two accounts measure up and how they equal each other. So just a recap of what we've covered. All transactions with countries are recorded in the balance of payments. So it has to be recorded in either the current, the financial or the capital account. The balance of payments is made up of the current account with no future obligation and the capital and financial account. So the financial account where we're recording all issuing of shares, all borrowing of money for businesses and so on and so forth. The current account has 4 subsections. The net primary income account is the one that's always the biggest deficit because that's where we're having all our rent and profits and mainly interest flowing back overseas. The balance of merchandise trade and net services together represent the balance of trade, which records all the value of exports coming in and imports coming out of Australia. Australia generally has a balance of trade deficit, but not always. But it always has a primary income deficit because of the large amount of interest we pay overseas. The fall in coal and iron ore prices in recent years have led to a larger deficit in the balance of merchandise trade section of the current account. The current account balance is recorded every year, so we record it as a percentage of GDP every single year. It doesn't accumulate, it represents the difference between our expenses and our revenue in any given year. So it's not like it's sort of, if it's 20,000 one year, you add another 10,000 the year after, and so on and so forth. Having said that, if we have a current account deficit of 20,000, say in 2015, and then 10,000 in 2016, it doesn't mean that our total debt's going down. It means that our total debt is still accumulating, but just at a slower rate. Australia's current account is constantly in deficit, and therefore every year we've had to borrow more money or sell off more assets. Thank you.